Krispy Kreme's 2003 expansion decision explains why rapid growth chose franchise buybacks and company-owned stores, while the brand's momentum looked unstoppable. One choice drove the chain into costly mistakes that took years to unwind. Here is what we need to understand. The early signals looked so strong that slowing down felt like the bigger risk than saturating markets. Between the April 2000 initial public offering and August 2003, Krispy Kreme stock climbed from $5.25 to a peak of $49.37, and that rise shaped expectations inside and outside the company. In mid-2003, Fortune described Krispy Kreme as one of America's hottest brands, and store openings drew long lines and heavy coverage, which meant the public story matched the market story. Heat changes decision-making. Unlike Dunkin' Donuts, which maintained steady franchise growth, Krispy Kreme chose aggressive territory buybacks. If this is useful, subscribe to Why It Made Sense. Fiscal results gave that optimism a foundation, and that is where the belief hardened into a plan. At the end of fiscal 2000, Krispy Kreme had 58 company-owned and 86 franchised stores. By fiscal 2004, it had 141 company-owned and 216 franchised factory stores, a footprint that looked built for a national brand. Revenue rose from $220 million in fiscal 2000 to $665.6 million in fiscal 2004, and diluted earnings per share increased from 16 cents to 92 cents. Those numbers felt like permission to accelerate expansion beyond what Dunkin' Donuts and other quick-service restaurant chains attempted. Product culture amplified the confidence, and that is when popularity started to look permanent. The hot original glazed donut, served fresh and warm, became a pop culture icon during this period, and the stock's run to $49.37 by August 2003 fit the idea that this was becoming more than a regional chain. With comparable store sales climbing and revenue rising, leadership could read the momentum as demand that would travel nationally. The energy was real, even as low-carb diet trends like the Atkins diet began emerging in the cultural background. From 2003 to 2004, Krispy Kreme decided to aggressively expand its U.S. store footprint by acquiring franchise territories and opening dozens of new company-owned stores. The company moved to reacquire franchise markets, including Michigan and Northern California. It paid $98 million for the Michigan franchise operations in fiscal 2004 and $16.84 million for the remaining 49% interest in the Northern California franchise in January 2004. That move brought more control than the franchise model used by competitors like Dunkin' Donuts. Instead of rapid expansion, it could have focused on improving existing stores' profitability and slowing new openings. The scoreboard in fiscal 2004 made the expansion plan feel settled. Net income jumped 70.5% to $57.1 million from $33.5 million in fiscal 2003, and diluted earnings per share reached 92 cents. Company store revenue hit $441.9 million in fiscal 2004, up 38.3% from $319.6 million the year before. The payoff arrived fast, validating the franchise buyback strategy. Comparable store sales performance strengthened the story, which meant growth did not depend on openings alone. Domestic comparable store sales increased 13.6% in fiscal 2004, driven by both on-premises and off-premises sales, a clear signal leaders relied on before pushing the footprint faster. Store openings sped up too. Krispy Kreme opened 28 new company-owned factory stores in fiscal 2004, double the 14 it opened in fiscal 2003. Franchising also looked like a clean second engine. Franchise operations revenue increased 23.5% to $23.8 million in fiscal 2004 from $19.3 million in fiscal 2003, reflecting 58 new franchise stores that year, net of closings and transfers. Franchisees reported combined same-store sales of $543.3 million in fiscal 2004, up from $459 million in fiscal 2003, which helped the scale story feel consistent across ownership models. The trend lines agreed, even as the Montana Mills Bakery Cafe acquisition showed Krispy Kreme testing adjacent concepts. Format experiments signaled that the concept could stretch beyond the classic factory store experience. By February 1, 2004, 9 donut and coffee shop test stores were open, including 6 company-owned locations, and by that date, 20 fresh shop retail outlets, supplied multiple times daily by local factory stores, had opened nationwide. Those tests fit the moment because they suggested more ways to reach customers without relying only on a single large store type. The plan looked expandable across multiple retail formats. That momentum created a specific kind of confidence, the belief that more footprint automatically meant more demand. Fiscal 2004 had the ingredients to support that belief, with domestic comparable store sales up 13.6%, and company store revenue at $441.9 million, while net income reached $57.1 million and diluted earnings per share hit 92 cents. Those numbers made expansion feel almost mechanical. At the same time, the rollout speed doubled from 14 new company-owned factory stores in fiscal 2003 to 28 in fiscal 2004. The system kept widening, with multiple format tests already underway. More places to sell looks like pure upside. It also raises the chance that the same customer gets counted twice. Here is the trade-off we see, and it begins with what rapid expansion can hide. By fiscal 2004, the footprint stood at 141 company-owned and 216 franchised factory stores, up from 58 and 86 at the end of fiscal 2000, and critics later argued the company expanded too fast and saturated markets. Growth into grocery and convenience channels was also cited as part of the pressure, because broader distribution overlaps with store traffic instead of adding to it in a clean way. Saturation is quiet at first. It builds over time, unlike the steady-state model that kept Dunkin' Donuts profitable. The story shifted when financial reporting became part of the headline. In January 2005, Krispy Kreme announced a restatement of its fiscal 2004 results, reducing 2004 profits by $3.8 million to $4.9 million, or about 6.6% to 8.6%. During calendar year 2004, the stock fell 66%, after having traded near $50 in 2003 and dropping under $20 by late 2004. Restatements hit trust. Trust is hard to rebuild, especially when the Securities and Exchange Commission begins investigating. Legal claims arrived with sharper edges, and that changed how every result was interpreted. Consolidated shareholder lawsuits filed in December 2004 accused the company of padded sales, alleging it doubled shipments to wholesalers at quarter ends from 2003 through May 2004 to meet targets. The lawsuits described this practice as channel stuffing and alleged it inflated revenue numbers. From January 2003 to May 2004, CEO Scott Livengood and 2 other officers sold more than 475,000 shares for $19.8 million, according to a shareholder suit, which intensified attention once confidence wavered and the stock began falling. The scrutiny tightened. The margin for error shrank. Federal scrutiny followed. On February 24, 2005, Krispy Kreme said it was cooperating with a Department of Justice investigation alongside an existing Securities and Exchange Commission probe, and the stock fell about 7% to $5.36. By early 2005, the share price, in the $5 to $6 range, sat far below the roughly $50 level seen in 2003, and later it would fall to around $1 by 2009. Scott Livengood blamed the Atkins diet craze for declining sales, though analysts were skeptical of this explanation. The price reset was sharp. Recovery took years. The operational unwind put real costs on paper. Between 2004 and 2009, Krispy Kreme closed more than 240 underperforming stores and incurred roughly $300 million in impairment and lease termination charges tied to those closures. Observers tied much of the strain to expanding too quickly and saturating the market with new stores and grocery-distributed donuts, which meant the company was paying to reverse decisions that once looked like momentum. The Securities and Exchange Commission examination of channel stuffing allegations added regulatory pressure to operational challenges. Closures are expensive. Charges add up. The later stabilization depended on changing how growth was pursued. In the late 2000s, the company refocused on cost controls and smaller stores, and by 2013, analysts credited a more thoughtful growth plan with turning the business around after the earlier crash. JAB Holding Company eventually acquired Krispy Kreme for $1.35 billion in 2016, taking it private before returning it to public markets in 2021. We can track the contrast in the same fact set. Fiscal 2004 shows $57.1 million in net income and $441.9 million in company store revenue, while the following years show restatements, SEC investigations, and a long unwind. The arc is clear. The trade-off was lasting. The lesson is not that growth is bad. Fiscal 2004 also showed domestic comparable store sales up 13.6%, and franchise results rising alongside a bigger footprint. The lesson is that rapid footprint growth carries saturation risk, and that risk stays hidden even while diluted earnings per share reaches 92 cents, and the stock still carries the memory of $49.37. Allegations of channel stuffing and aggressive accounting can mask underlying problems until Securities and Exchange Commission investigations bring more transparency. We can see how this led to years of closures and charges once the story changed and credibility became part of the business problem. The decision was logical. The consequences were not. More decisions like this, subscribe to Why It Made Sense.